Ladies and gentlemen, please welcome your panel on Credit Markets Back to Neutral, moderated by Barron's senior reporter, Mary Childs.
Hi, everybody. Thank you so much for joining us today. This is a very awesome panel. I'm stoked to hear all the opinions we got up here. We have, starting from my far right, Mike Buchanan, Deputy CIO at Western Asset. Here we have Mike Damaso, co-founder of CBAM Partners. Jude Driscoll, CIO of Public Fixed Income at MetLife. Justin Slatke, co-CIO at Schenkman Capital Management. And Ann Walsh, CIO of Fixed Income at Guggenheim Partners. We have a really all-star lineup. And we have a lot to get through. The economic cycle seems to have been extended again. The Fed is on hold possibly forever. And there's relatively strong economic growth. Things seem fine. So all of this is a little bit too much good news for bond people to handle. So I wanted to start off with some of the things that we've been really fretting about, the anxieties. We've been, it's rich land for talking about triple Bs and all the anxieties there and covenants. We have a lot of kind of anxieties to get through. And I wanted to kick it off, I think, with the ballooning lowest rung of investment grade triple B. That's been something that people have been really hand-wringing about for a long time now, a year, 18 months maybe. And I'm very curious how this panel views that and how we kind of approach that from a trading perspective. So, Mike, do you want to start off?
Yeah, I'll kick it off. And we were just joking around that I'm the only, we brought one slide, and we're going to kick it off with this first slide because it's very, very appropriate for the question that you asked. You go back about a year and a half ago, and investors started to become increasingly aware of the growth in the triple B market. And I think everyone knows the statistics. It's almost 50% of the investment grade market now, and the investment grade corporate market has more than doubled since the crisis. So, the real question is, what happens when a recession hits? Not if, but when. Aren't all these triple Bs vulnerable to going down into high yield? We all know that liquidity is challenged in all fixed income, but as you go down into lower credit quality, certainly liquidity is even more challenging. Our view on this is that certainly it's a risk and we're aware of it, but we do see some behavior that seems to be shifting. And I think this slide, what we did is we worked with our research team. We took the top 25 triple B issuers in the investment grade market, and we just said, let's first look at very near-term trends in leverage. What's happening with leverage, not over the last 2 years, but really over the last quarter, maybe even in the last quarter, sort of a trajectory. And we asked them to just basically say lower, stable, or higher. And you can see here green is lower, and there's, I think it's 13 that are green and only 3 that are higher. So clearly, if you just look at near-term trends, you do see some encouraging deleveraging trends. And then on the far right, if you look at what is their stated goal? Do they have one with respect to leverage? And you can see 5 of the top 5, the 5 largest issuers, actually do have a stated commitment to deleveraging. And you can see, again, going down a lot of green on that list. So I think what we're seeing in our view is that, yes, there's a huge risk here, but corporate management teams are very aware of this, and we do think they're being proactive and they're doing what they can to avoid going to double B. And we do think you're in the early stages of sort of a reversal of that levering trend that we saw in triple Bs, and that over maybe the next 4 to 6 quarters, you'll see some delevering in that triple B category.
Yeah, I think we would just add, and we agree with Mike that in general, most of the triple B companies are doing the things to delever. But what we think we saw really in the last quarter of last year is macro funds and passive funds that have entered the investment grade market have increased a level of volatility in the marketplace. And now that triple Bs are such a big percentage of that market, the level of volatility you're likely to experience in investment grade is much higher than historical. And when all the models were created as to how much investment grade people should have in their portfolios, they didn't really incorporate this level of volatility. And so as pension investors think going forward, we think rethinking how much investment grade is as a part of the safe part of your portfolio is really something that'll need to happen over the coming months and years.
So is there, the great fear there too was once we have this, any downturn in the cycle, or if some kind of, exogenous shock or whatever, that all these companies would abruptly be downgraded, probably in a huge wave, just like the wall of maturities always hits us. Is there, what is the risk there that actually, if there is a downturn, that they would all become fallen angels at once? Like, how would that get processed in the market?
I think it's a lot of the distress cycles that you've seen. There's a moment of indigestion, but I think we've also seen, just given how healthy amount of money there is of dry powder, whether you look at the private equity firms' dry powder, or you look at the mutual funds that on the fixed income side have seen a lot of inflows. I think you always have moments of indigestion, but those are also times for active money managers to really create alpha. And our equivalent at CBAM, we spend a lot of time focused on below investment grade, but our equivalent to the triple B glut would be B3s. There's been a huge influx of B3s, which has gotten everyone's attention. Like triple Bs, not all B3s are created equal. We do a very similar analysis, Mike, where we call it, it's really a heat map, where we also look at our earnings trending higher or lower. What's nice, I don't always agree with what rating agencies say, but they do provide you a very good roadmap in below investment grade where, when these LBOs get done, about 70% of the companies we lend money to are private equity owned or family owned, and about 30% are public. And so on the private equity side, you can imagine there's a lot of leverage being deployed to purchase these companies. What's interesting, though, is let's say a deal time leverage closes 6 times. Moody's will write in their write-up, if the company goes to 7 times, we'll downgrade. If they go to 5 times, we'll upgrade. So they give you there is a roadmap. And to your point, you have to look on a quarterly basis. Historical numbers have become less relevant on a long-term basis, just given how much change there's been going on in the world. But we really sort these B3s every quarter, and we assign a green to people that are getting further away from the downgrade leverage multiple, and a red to the ones that are getting closer. And I think that, as an active manager, a lot of the CLOs, I think north of 50% of loans are held in CLOs now for below investment grade. Triple C is like the worst possible thing that could ever happen to a 10 times leveraged CLO. And so you have to be very active at looking at the B3s that are trending green versus red and manage your portfolio accordingly.
You bring up something really interesting there, and Anne, I want to bring you in on this. The ratings agencies and the kind of frameworks that they apply, and the kind of standardization or lack thereof in rating these companies and their trajectories. Can you talk a little bit about how much you trust the ratings that are given, how much you, what that process is like?
Yeah, so a couple things that have been said already, and I want to comment on them as well. But with regard to the rating agencies, and I like the chart that was up a few moments ago with regard to leverage trends are lower. $1 reduction in debt means the direction is lower. I'm not necessarily sure, and this goes to the question of rating agencies as well, whether rating agencies aren't in fact enabling these companies, these issuers, to have a higher level of debt generally, and that the leverage ratios are actually much worse and more, particularly for triple B credits, more in line with, say, double B credits. We have done a macro level analysis, and approximately half of the triple B market is actually carrying leverage ratios that traditionally were in the double B space. And this is again being enabled by the rating agencies, in our view, similar to what was going on before the financial crisis with regard to non-agency mortgage-backed securities. Sort of this rating to an expectation of future deleveraging, which that sounds great as long as everything continues to go well in the economy. If, however, the economy were to turn south, and I know there's a number of negative views out there, ourselves at Guggenheim, we have one as well with regard to when the recession could occur. But in a recessionary environment, when the music stops, some of these companies aren't going to be able to find themselves in a position where they can really do the deleveraging that they've promised the rating agencies. And so there's some real risks that have emerged in this triple B space. And just taking Moody's analysis, Moody's suggests that over the 5-year timeline, triple B companies have an 18% chance of being downgraded into non-investment grade space. And so given that, you could see a tremendous default or downgrade wave in the next crisis cycle.
Do you want to jump in on that?
Yeah, I'm just at the page. I'm just thinking about. I think there's a little add-on to this. The triple B and single A, which we've been looking at a lot, The size over the last 10 years is up 250%. So there's a huge leveraging there. Two is in the single A space, the interest coverage has gone from roughly, and this is over the last 3 years, roughly 17 times to around 12 times. Triple Bs are around 10 times. So there's deterioration there. And then to Ann's point on the leverage, 2.5 to 3 times, and some of these companies are six times levered. That adds to a little bit of the worry. One of my other worries is, as kind of a crossover guy, is as you get low triple Bs with long-term maturities dropping into the high yield market, it's a little bit of a no man's land because no one's buying 30-year high yield stuff in bonds. So that's that'll probably be a pronounced drop. You guys could probably talk to that a little more. But the good side to it is all these companies generate a lot of cash flow, and the ability for them to de-lever is there. Now, what will suffer there is dividends, CapEx, and anything related to the stock. So, there's a little bit of knockoff on all of this stuff.
And a lot of that is, as we were saying, kind of predicated on that economic cycle and things, like Ann said, everything going really well. So is there, with the kind of changes in the Fed's stance, can you talk a little bit about Justin, I'm going to bring you in on this one. Can you talk about where you see the credit cycle and how monetary policy plays in here?
Sure. From our perspective, the credit cycle has continued to be extended. And as we got towards the latter part of last year, a lot of the hiccups that we felt were really Fed-driven. The Fed came out and basically said, we don't care that China's slowing, we're going to continue to increase rates. And the markets responded very poorly to that. And you saw a large sell-off in the credit markets. The pivot that we've just seen to start this year really resets the extension of the credit cycle. And so when you have that reset, it's unlikely to be unwound so quickly. And so I think where we feel like we are is that the cycle does continue to be extended. We're likely to have a relatively benign credit market. GDP between 2 and 3% is kind of the sweet spot for high yield credit because companies generally are a little nervous to do really excessive things. So you don't see leverage multiples increasing dramatically, which is the same world, by the way, we've lived in for the last 10 years. But at the same time, they continue to grow modestly. And so they can grow into capital structures. And so that is the environment that we continue to see. However, and I think this is important for investors, because everyone in the world believes we're towards the end of the credit cycle, anything that happens that confirms that view will lead to large amounts of volatility, just like we saw at the end of last year. And so what we expect to happen is to continue to see V-shaped trading. Something happens, we all expect we're at the end of the cycle, bonds trade lower, people calm down, and they recover quickly. And so from an investment perspective, you really have to be prepared for quick decision-making if you want to take advantage of those sell-offs.
Absolutely. Damaso, we've talked about this in the past, but can you walk through kind of how you handled the October-December sell-off?
Yeah, it's interesting. I think we're traditionally fundamental analysts, so we look at financials, and most of our decision-making is kind of traditional due diligence. I think a lot of what's controlling our market now is more technically driven than fundamentally driven. And coming out of third quarter earnings, there were pockets of problems if you look at certain companies or certain industries, but by and large, our heat map on earnings was still pretty good. I think what we saw when the Fed took a pause, you saw a lot of money flowing out of floating rate and going into fixed rate, which in below investment grade is kind of ironic because if we think there's a recession company, typically the paper that should perform better is the floating rate secured debt, which is top of the capital structure, not the fixed rate below investment grade junk bonds. So we kind of studied the fundamentals of the earnings, and you had about a 18% drawdown on loan mutual funds in that kind of December, January period, and we really viewed it as an opportunity to upgrade our portfolio. And when you have that kind of massive technical unwind, it does create pockets of opportunity to either increase the rating of your portfolio, increase the coupon, take out par. And those are moments of time. we've all talked about this 9-10-year bull market that we've been in. You have to find these pockets of volatility to create alpha. Otherwise, there's a lot of coupon clipping that's been going on, and it's really hard to differentiate. So I think being very organized, understanding if it's fundamentally or technically driven sell-off, and really then treat and trade your portfolio accordingly.
Yeah, I would say too that when we were in the midst of that fourth quarter sell-off, in particular in December, at Western Asset, we really looked at that as a gift, because we felt like the fundamental environment really wasn't changing, and we had continued to believe in that fundamentals have been supportive. We continue to expect them to be supportive. But as Justin said, when the Fed pivoted, that reset everything. And from our standpoint, it was just you take advantage of that. We tried to start buying. High yield went from 300 over to almost 550 over. We tried to start buying in December. Liquidity was a little rough to do that, but by early January we were waving it in. I think the more difficult question is, what do you do now? Because we've retraced almost all of that sell-off. So, here we are at high yield at 350 over. It's not as easy of a decision right now if you own it or you want to keep those longs on that you had. But just to give you a preview of what we're thinking, we are keeping that on. We do think that this is going to be a year where carry prevails, and you'll get some volatility for sure, but we think between now and year end, you're likely to see spreads tighter in most fixed income risk markets. Not dramatically tighter. We've seen the magnitude of the tightening, or the main tightening that's occurred, but you can get some incremental tightening from here.
Would you like to add anything to that?
Yeah, I mean, one of the things that we looked at coming through the fourth quarter, but more importantly in the first, one of the toughest thing about today's market is just the relative spread. Risk versus non-risk, everything's really tight. You have 10 trillion of debt in the global ag that's sub-zero. It's pushing everybody out to risk, so it's bringing, your risk spread between risk and non-risk is very, very tight. I mean, one of the portfolios that we have is a 6-month portfolio, AA rated, 285 yield, versus the BB market, which, I don't know, 8 years? It's 200 basis points different. It's just not sustainable over time. But what this does is the market moving in one direction is very difficult for people like us. Fundamental guys roll up your sleeves and you do your research. It's really difficult to play through this market, and really I think where we are today is, let's find the things that we really like and get out of the stuff you don't like, but waiting for the opportunity, because there's going to be an opportunity to be really dig in and look at credits and know what you want to buy and be able to go out bond by bond and build a portfolio. Today's not that day, but we're looking forward to it.
I do feel also, when you're talking about the public markets and the, you're kind of fighting for very few basis points given the risk, there's been this move into private markets, right? Everyone was obsessed with direct lending, private credit, anything in that umbrella. And that feels like at first that was driven by a desire to go kind of off the run and be able to find something where you're maybe getting more compensated for the risk, but it feels as though perhaps we've overshot that. Do you want to start off on that one, Justin?
Sure. I think that we've obviously seen a dramatic growth in private debt because the banks and other parties that were in that market have taken a step back. The reality is that private credit tends to be smaller companies, and they have less levers when there becomes an issue. So when you're in a 10-year bull market and you lever private debt a couple times, it feels like a great investment, and it will continue to feel like a great investment as long as there are no hiccups in the economy. But as you get any stress in the system, these middle-sized companies, they usually have a much harder time reacting. And that is really where the issue becomes, because then you have to go on the boards, you have to figure out how to adjust management. They're not big companies that attract the best talent. And so you have to make sure that you really have an investment thesis that enables you to play through a longer period of time. In the public markets, you're able to kind of make a decision every day and mark to market and change how you view how you're investing based upon the new information that we have. And so Private debt felt really good through the third, fourth, and first quarter because there were no marks. But if the Fed hadn't pivoted, I think it could have been a much different story. And I think that what I worry about is so much private debt money going in because you can't see what the levels are. And if you get hiccups, that could be a very different story.
Let me add on, if I can, a few of the things that Justin's just said. So there's a lot of very substantial changes that have happened in the private debt markets. Traditionally, you had banks who were lending, and if you go back pre-crisis, they had they would retain about 80% of the loans on their balance sheet and participate out about 20% into the sort of private debt market. That's reversed in the post-crisis years, and now banks are holding about 20% on average relative to participating out the remaining portion. So you have a new investor base. That's one element that's a substantial change. The second one is we also have the rise of new investors into this market. And that creates, for me, a level of concern because these are investors that traditionally have not been in this market. They don't carry the knowledge, and they may be naive, particularly passive investors through ETFs or other mutual funds, but predominantly ETFs, where there's a substantial mismatch between the liquidity of the underlying asset and its ability to be traded and the liquidity option that's actually given to the investor to be able to exit out of an asset class that does not have that kind of level of liquidity on a moment's notice. And the concern that I have, in addition to the fundamental areas of lack of knowledge or investor capabilities, is simply the run on the bank. And if there is a turn in the market, to your point, my concern is that this particular investor base is not tried and true. We don't know how they're going to react, but the expectation is they're going to react and create a high level of volatility in this market rather rapidly, and then it will infect that market, if you will, run could infect then the higher rated categories as well, as investors run to try and find liquidity wherever they can. So there's a lot of concern if we actually have some sort of exogenous event that sort of triggers this slide, particularly since I think it could potentially start in this private debt space.
That's a great point. And I think that hits on something that we've talked about probably for the past decade about market structure, right? There's been such a huge shift, like you're saying, between the banks and the buy side, and trying to navigate that difference. We had kind of a dry run in a way in the end of last year, but it is something that has to be very carefully monitored, I feel. And for all the conversation that we've had, it doesn't necessarily feel like there's been a real resolution to, okay, how do we trade this? Yes, it's an opportunity to be a liquidity provider, but what does that actually mean? Does either Mike want to take that?
I'll take a shot on it. I do think that the markets have changed for sure. I mean, the dynamic of growth across all credit markets has been compounded, or the illiquidity from that has been compounded because of really regulation. I mean, most of the broker-dealers now can't have as much inventory. They can't allocate as much capital to inventory. So you've got bigger credit markets. You've got a smaller sliver of capital that's there for our day-to-day counterparties. And what I think that translates into, and we're seeing it, is volatility. It doesn't mean, I mean, the big money comes in when the value's in the market. So you see, like, you just isolate December, you see that kind of sell-off. And again, I mentioned earlier, that really wasn't driven by fundamentals. It was really mostly a technical issue. There were a lot of sellers. The street back in the old days when we all started in this business would expand their balance sheet. When things got cheaper, they'd contract their balance sheet when things got richer. And there's just a limited amount of capacity to do that. So what happens is these markets find those value points abruptly and quickly, but there's a tremendous amount of capital that's there available to deploy when you get to these good levels. And usually the market can't satisfy that, which is why you get these really V-shaped recoveries. How do we deal with it going forward? I do think that electronic trading, online trading, all-to-all trading We're seeing it improve. I think you're going to continue to see developments in that direction. I think you're going to see electronic trading and all trading taking up an increasingly greater share of the overall secondary volume. I still think that you're not going to lose the primary dealers. They obviously serve a very valuable purpose in terms of underwriting. But I do think we're in the midst of a real sea change here.
Do you think one second.
No, I was just going to add, the unknown is always the scariest part, right?
Right.
What is going to be the next shoe to drop? What creates the next recession? But those are always the things as managers you're trying to figure out. But what I would say is, if you looked in 08 and 09, when we went into, the Great Recession, the issue was, frankly, where paper was sitting, right? And banks were stuck in underwriting $100 billion of below investment grade paper. They had a lot of TRS or mark-to-market financing out to the buy side. And I mentioned that indigestion, there was a whole moment. The reason loans traded from par to 60 wasn't because the credits were bad. It was because you had to move hundreds of billions of paper from one aisle to the other side of the aisle. I think if you look at today, and because regulators have clamped down a little bit on bank practices, it's good that most of the paper is in the buy side, because we are in the storage business. Banks are in the moving business, right? They want fees. They're not so interested in holding below investment grade paper. So while there's lots of unknowns, I think I'm much more positive, or CBAM is much more positive on what things might look like if we had whatever everyone's views of a recession would be, given that the paper is now sitting in the more long-term traditional hands than it was in 08, 09.
That makes sense, and that's reassuring. Yeah?
Yeah, I was going to say, it's better that it's in the buy side, but the speed bumps have been taken out of the marketplace. The broker-dealers slow the market on the way down, and they slow it on the way up because they take in paper and then they put it back out. When you get rid of those speed bumps, even when it's in the right hands, if you think about, the bank loan market has a large mutual fund component. And so there's a big retail component. High yield has a very large mutual fund component. And when they see price movement without speed bumps, it scares them. And when they get scared, they sell. And that can create much more movement in price than what we're used to. And so I think given what's happened in the market structure, if you look at historical volatility characteristics of either asset class, we expect that volatility is going to be higher than what we've seen because of this change. We also actually think that return potential will be higher in both asset classes because buy side will be able to buy bonds and loans at prices they never would have seen. Those broker-dealers would have bought that paper and kept it on their balance sheet. And now, if you have the capital to take advantage of it, you'll be able to buy bonds and loans at much lower prices. And as long as you can hold through, you'll benefit from this market structure that really is not set up that well yet to handle any kind of reasonable volatility. We saw it in the last year. We saw it at the beginning of 2018 as well.
Yeah, but your portfolio has to be positioned in such a way to be able to take advantage of that market opportunity when it comes, and to have the capital sitting on the sidelines ready to come into the market to provide that liquidity element. And the concern that I have in the shorter run is that, to your point, which is that while the buy side is facilitating the storage business, I like that term, at the same time, we're facilitating a new investor base. And we've talked a lot about the retail maybe market in terms of the mutual fund holders, but there's also a tremendous number of non-U.S. investors who are buying in the U.S. market, particularly back on the topic of BBB securities, because of the $10 trillion of assets out there that are trading at negative yields. And even after hedging costs, this new investor base, predominantly out of Asia and Europe, are able to pick up some yield relative to the negative yields that they're otherwise earning in their particular markets. And they're coming into the BBB space. We saw quite a bit of nervousness out of those investors in December. And so if that had prolonged that period of negativity relatively, and the Fed hadn't come in and taken action to stabilize the markets in January and February, we might have seen a very different situation in terms of those investors maybe potentially either not deciding to continue to invest in the U.S., but maybe even taking their assets away and being a source of negative capital movement. So we didn't get enough of a timeline to really judge whether or not there's going to be serious action. But we did see a very significant lack of liquidity. And to the point about the street, I mean, they became what I would call realtors. They were, lining up a buyer and a seller. They're absolutely not a speed bump. They're not even the oil or the lubricant to the market at all anymore. And they're not really coming back. The cost of carry is too high, the regulatory requirements, and so forth. So we have some really significant issues that are happening in terms of this new investor that we just really don't know what ultimately is going to happen. But positioning your portfolio and being ready to be a capital provider is going to be a very substantial benefit to investors if you can do that.
Does that mean that as a manager, you just have to have a higher allocation to cash at all times, or things that are really liquid that you can trade in and out of easily?
I think liquidity, and liquidity can be a significant myth. So in our core portfolios, that means treasuries and agencies. At this particular time, we've seen a big move, obviously, in the treasuries in the last few months in terms of that. But at the same time, they can be, at some point in time, readily converted into cash and or to the opportunity to invest in triple Bs or even non-investment grade space.
Mary, I think there's also and I agree with that. I think there's that untested cohort that has grown dramatically in terms of representation within corporate credit. And we don't know how they'll handle things going through a recession or a real prolonged period of distress. But that being said, I do think if you go a little, go even below that, you have a lot of money that's been raised. Maybe that money's not just sitting in cash, but it's money that can be drawn to go after opportunities, dislocations in the corporate credit market. And I think there's plenty of capital that's actually very excited and eager to see this kind of stress, this kind of volatility, to get those kind of opportunities. So it doesn't mean we won't see something that's abrupt, painful, certainly from a mark-to-market standpoint. But again, I do think it's not like there's this void where you have absolutely no capital. At a certain point, you're going to have real significant money come into the market to go after those value opportunities.
With all those changes, did you want to add to that?
No, I'm thinking about the technicals of the market, but also the private side. And being part of MetLife now, there's a lot of focus on the private markets, which for an insurance company makes a lot of sense. Less liquid, get more yield, write your own covenants. So they think about that a lot, which is good. The key to the market, though, on the private side, away from technicals, is less about the buyer, and it's more about who's writing it to you. And I think you have to be really careful, and you have to do your research and think about who's the sponsor of this private debt. And that sponsor has probably changed a lot, and it's going to change the profile of the private market, not only the private market, but to the loan market. If you go down, a good example of this is if you go down to the B3 loan market, that market on a percentage basis of loans has gone from 2% to 10% of the loan market. That's a big jump, and that's over the last 3 or 4 years. And of that, it's PE sponsored. So you have B3, PE sponsored. Where's the money easy? That's where they were going to go. So part of it is thinking about the technicals and the buyers and who's out there. But the other side is who you're buying from. And do your research and think very carefully about all of the credits that you're buying, because when it does fall apart, the old days when you said, well, I had my covenants and privates, I had all of this stuff, I was top of the capital structure on the loan side, and I feel comfortable with that because look what it did in 2008. Well, it's different today, and there's a lot of that market that on the loan side, on B3, that is also loan only. So you really have to do your research. You have to think about what you're buying. And at some point, this is going to happen. Things are going to fall apart, and there's going to be value out there.
Yeah.
And you need to be able to do the research and really dig into a lot of these credits. And that's where you're going to get your performance.
I think it's a good point on the who the sponsor is, because when you're looking at the investment itself, you're looking at the loan to value or the leverage multiple, and you're understanding how much cushion, how much junior debt or equity in the leveraged finance world of cushion you have what capital would have to be destroyed before your loan would be impaired. And we did a study where we took the 20 largest private equity firms and looked at their last fundraise, and there's some big fundraisers, $5 billion up to $20 billion, and really understanding when they make an investment, how important is it to their fund? You know, if it's a 3-4% position in the fund, that's very different than if they're saying we're going to put 15 or 20% of our fund into one name. It's not the only, clearly it's not the only underwriting that you have to do, but knowing that a sponsor is looking to hit doubles, triples, you know, in a lot of cases 4 and 5 baggers, we're in the business of loaning money at par and trying to get it back at par. So I think you really have to understand the motivations of the sponsor. You know, is it just an option to them that might pay off big and they're willing to take a zero because they can earn their return on other investments? So I think it's a really good point that you
Yeah,
made on
these
the
guys are
sponsor side.
smart. They're really smart. And they know where to go, and they're going to go where the money's easy. So
And
make
it's
sure you
gotten
know
a-
who you're dealing with.
Yeah, and it's gotten a lot worse. Also, I can't believe it's taken us this long to get to covenants. That you've seen over the past, you know, especially over the past 5 years, maybe this kind of deterioration in covenant quality, and you know, whether that's a maintenance covenant. In many cases, that might just mean coming back to the negotiating table. But without those triggers, it feels like there's maybe more opportunity to stay outside of bankruptcy, to burn assets. Is this something that you guys fret about with regularity, and what can you do about it? Everyone's excited.
Yeah,
This is the best
yeah,
one.
I think it's,
Yeah, I mean, it's clearly a big issue for the whole market. But covenants in and of themselves don't create a problem. If you buy a good credit and the fundamentals hold up, it generally doesn't matter what the covenants are the entire period you own it, because you're going to get your money back. It's really when an issue comes up and a problem when you need that covenant. And so what that means is, as a debt holder, you just want to know that you're going to be treated as a stakeholder within that company. And what we've already seen as covenants have declined is that there are certain private equity sponsors that view us up here as stakeholders in their companies, and there are certain private equity sponsors that view us as people that loan them money, and maybe they don't need to give it back. And I think that as we go forward, and I think Jude highlighted it, knowing who you're investing with, knowing how they've treated you in the past is a critical component to how we're going to invest our capital going forward. And I think that you know, the buy side does control a lot of that capital, and it's important that the active managers really tell people and private equity sponsors how important it is that we're treated just like a stakeholder in the company. And there's lots of things that we can do to show that in the public markets. But I think that as we go forward, it's highly likely that you'll continue to see behaviors that are different than what we've seen in the past.
Well, yeah, and the bigger risk also with the lack of covenants is that you end up with no warning signals that something's going wrong. And that combined with really what's been excess liquidity sloshing around in the market, you end up with this crisis at maturity. So Toys R Us is a really good example. Everybody knew Toys R Us was having problems. The whole retail industry is having problems. Yet, while the bonds were downgraded, so the rating agencies were alerted to the issues, the price of the bonds remained high until almost at the very end, right before the bankruptcy. And so you had liquidity and, oh, by the way, passive investing, because the bonds appeared in an index, holding up the price of those bonds. You had no real early warning symbol or signal, I should say, with regard to the covenant warning us as investors that something seriously was going wrong and they should have been restructuring earlier. And so you end up with them, you know, failing at the end. The concern is we're going to see companies move not just down in credit, but almost immediately to default. And we saw some of that in the energy sector and what I call the mini crisis that we had a few years back, and that is that these companies are simply going to move into an immediate situation of default. And today, because of the Fed and because of the element of liquidity that's been there to provide for them, they're what we could call zombie companies. There's a number of companies out there that are actually, they should be on life support, they should be engaged in renegotiation of their debt agreements and so forth, but they're hanging on because they've been able to. And the concern is that not only will they default at a higher rate than in past cycles, but that they'll also have much lower recoveries. Again, going back to that mini cycle that we had with energy companies, that's what we saw then too. And so in an environment where we could really see a big risk off and these institutions aren't able to refinance their debt, we could see a real significant default cycle, not just a downgrade cycle.
I think it is interesting because it seems like it's become accepted that lack of covenants is going to lead to lower recoveries. And if you think about it, recoveries are the accumulation of all the cash flows that you've gotten from your investment. And so if covenants allow companies to stay out of bankruptcy longer, you'll get a lot more coupons. So your end recovery might actually be lower than what you've gotten historically. But if you got a lot more coupons over the time period, it's not clear that your IRR is going to be worse. And so I just think that's something important for investors to realize that, obviously lack of covenants is a problem, but it's not necessarily definitional that it'll lead to much lower overall returns.
Yeah, you start to get some negative convexity in corporates, that's fun.
Yeah, I think that the C word that's more important than covenants now is collateral. I think it's always been viewed that, again, in the leveraged loan space, that if you were a first lien lender, you had all the collateral, and if things went bad, the people below you, the capital below you would get hurt. I think you've had very aggressive private equity sponsors with very aggressive legal counsel really just frankly destroying the documentation of what were the tenets of a loan. And ultimately, they have now all these loopholes to basically distribute what used to be first lien collateral when going through a restructuring to negotiate with bondholders. J.Crew was a big story a little over a year or so ago, where they were basically taking collateral and moving it to a different box. It was the IP of J.Crew, and effectively being able to negotiate a deal with bondholders to kind of keep the story alive. And I think that, to me, is going to be the biggest problem going forward in terms of ultimate recoveries, is that you are going to have, notwithstanding the larger coupons you're clipping, but the issue that the ultimate recovery, we believe, in the next cycle will be materially worse. Maybe not in totality, but industry by industry and credit by credit. And so our view is, now more than ever, it's important to be very active traders. I think the idea before of taking and riding companies into bankruptcy and working it out through bankruptcy, you could have some success doing that, but I think there's going to be a lot of problems, all the maneuvering that owners and private equity firms will do before going into a controlled bankruptcy environment. You're going to see a lot of leakage. And I think we're very cognizant of, just because you used to be able to watch a loan trade from par to 70, go into a reorganization and find a way out and get your par back. I think that's going to be less, the ability to do that will be less the next go around.
So Toys R Us was really a preview in that way as well, that it's just kind of
there's a number of examples out there of companies maneuvering now. The lawyers will be happy because there'll be a lot more lawsuits. Right. I think banks will deal with more lawsuits, private equity deal with more lawsuits. And as a result, I think bankruptcy process, unfortunately, will be longer. And so if you're looking at an asset going in that the company's not paying a coupon, the ultimate returns might even look worse because you're spending a long time not earning any coupon while you're in that bankruptcy process in a lot of cases. So we're very active trading when we think a company or industry is going south.
Yeah. The other thing is that you want to, coming into privates, negotiating, privates coming in, and then on the back end, if something does go wrong, having experience there. And working now at MetLife, Nancy Mueller has a team that's been doing this for 30, 40 years. So experience in this does matter on the underwriting of these securities and building up a big book of it.
So having that expertise when you go
Absolutely.
in and being able to navigate successfully.
Yeah, absolutely. It makes a huge difference.
One of the things that comes up a lot in conversation is you do seem to have such a quick turnaround when you get those documents. It's like 500 pages that you're supposed to read in 10 minutes, which seems immensely feasible. Are there ways to kind of add accountability and say, how can we make this push back a little bit against these issuers and against the sponsors?
I was chuckling the other day. I was watching CNBC of all these unicorns that are all rushing to do IPOs right now, and I can't remember which. It was CNBC or Bloomberg, and the commentators were overwhelmed because the S1 got dropped and they had to like comb through a 400-page document. I'm like, well, we have to do that every day, and we have 24 hours to like go back with our comments. And the problem is, because the market's so hot, because there's hundreds of investors participating, it's been very hard to get lenders to kind of come together to stop some of these changes. There's just too many people. So our view is there has to be a new way to standardize how to kind of rate these credit agreements. And because people know, like, a B3 tells you, at least a rating agency thinks this is this kind of risk. There has been no historical standardization to say this credit agreement is generically good or generically bad, because there's so many elements, obviously, in a 400 or 500-page document. And so we've been working with a lot of external vendors to come up with an actual score. And so what I think you're going to start to see is when people start talking about, okay, it's rated this, and this is the coupon, this is the maturity, 9 out of 10 are going to be covenant light, but on a scale of 1 to 10, how bad is this? And then you're going to start seeing, like, I don't call them league tables, but you're going to start seeing charts that rank private equity firms from the most aggressive documents to the least, but it'll be in a numerical form. Right now, it's not very tangible for people because, again, they're overwhelmed by the sheer number of credit agreements they're trying to comb through. So I think it's going to be helpful, and it might create an environment to start really pushing back, because everyone says, oh, this is a 4 out of 10, or this is a 7 out of 10. I think you're going to have a real chance as lenders to maybe start talking numerically about how bad some of these documentations have gotten.
I think being able to have that kind of communication and documentation is critical to make sure that we can look back and have some accountability for what's going on in the marketplace. It's not just in covenants that we're starting to see it. There's been this advent of EBITDA add backs for new issues. And so if you go back to a period of time that we all think was excessive risk-taking, 2007, 20% of all new issues had EBITDA add backs. Last year, 80% of all new issues had EBITDA add backs. On average, it increased EBITDA by 45%. The reason that's so critical is we've now been in an elongated cycle, so we actually have enough time to look back. And if you look back over the last 2 years, what you'd find is that 75% of companies have missed their guidance with the EBITDA add backs. Why is that important? Not only is it because the numbers we looked at new issuance were wrong, it means that the rating agencies, when they originally rated the companies, were rating them based upon these EBITDA add backs. And then as they've missed them over time, they have to re-rate them. So if you look at the last 2 years where we've been in quite a strong economy, if you look at bank debt, downgrades to upgrades are 2 to 1. 2 downgrades for every upgrade. That shouldn't occur in an economy like we're in, but it's occurring because these companies are coming with numbers that actually wind up not being the case. So having accountability on covenants, having accountability for the numbers that they're putting out at new issuance is critical, and I think anything that the buy side can do to create that accountability would be very good and healthy for the overall market.
It's surprising to me that you guys don't enjoy reading those more, because I personally like fiction better than nonfiction, so I feel like it seems fun. Anne, did you want to jump in?
Oh, I was going to say, it requires a tremendous amount of resources to be able to invest in private debt and private securities. And at Guggenheim, in order to deal with these, last minute, here's your 400-page documents, we have a whole team of attorneys, transactional attorneys, who actually review these documents alongside of our investment professionals. I mean, these are resources that aren't available to every investor, and I think it's critical that we have to recognize the risk that's happening and rising because of the legal documentation that is actually not supporting, in many cases, our investment thesis. And we're talking obviously about corporate credit today, but structured credit even more so, how critical the documentation is to support the investment thesis. And it's just becoming harder and harder as an investor. But this is sort of what happens at a late stage investment cycle. We always tend to migrate towards this availability of credit being virtually free. So we've given the treasurers of corporations, and in the case of private debt, also sponsors, sort of a free option to take advantage of lenders. And And it's really quite a challenge to hold the line on whether it's whatever stipulations you require or whatever covenants you might need. And collectively as an industry, we need to be a lot more thoughtful, but this is sort of where we are in the cycle. As a result, pulling back from these opportunities is the only way to avoid this risk, is to say the risk is much higher than we're getting compensated. And it had been that as we moved down into credit and into less liquid assets, that's where we were getting paid. Well, now that we're not even getting paid there, we then have to say, okay, where else can we potentially put our capital and park it while we wait for the cycle to shift, which it always does. As an investor, we're not new paradigm investors, and so we've seen this show before, and we know how it ends. So we have to be really aggressive back with the issuers with regard to what we require.
Mike, did you want to?
Yeah, we've talked a lot about covenants, and I agree with all the points that have been made. I would just add that I do think it's a delicate negotiation. Right now, there's a lot of capital that's available to go into the loan product. And I don't know any investors that like a lack of covenants. Everyone pushes back generally. But there are other ways to push back. You can push back with pricing. You can push back with call protection. You can pick your poison. Mike talked about collateral stripping. That's something that we think is more and more prevalent. And you really want to focus on that. And so what I would say is that the first line of defense is always research. It's always picking companies that you think can withstand and navigate through a challenging economic environment. So you start there. And then from there, it's what's important to you, what do you want to focus on, and hopefully when you're working on a transaction, you could get to something that is mutually agreeable. Again, you always want everything, right? You want the highest yield, you want the best covenants, you want the best call protection. In this type of market, you're not going to get that. So you just got to figure out what is the right relative value framework.
So I want to take some time for audience questions, but so you guys be preparing, think about your most amazing questions that you want to throw to this expert panel. And right before we get to that, I want to do kind of a lightning round with y'all. As it's a really magical question. I like this one. What are the risk metrics that you monitor that are kind of the canary in the coal mine? When you see whatever it is, maybe an inverted yield curve, because it's always right, do you immediately say, okay, it's time for me to kind of get more defensive, or conversely, to get more aggressive? Does anyone want to start? Favorite risk metric?
I'll start. It's undeniable, the economic cycle. You have to start with the macro, and you look over time. Recessions, increases in default, spreads widen. There is a really, really strong correlation. So, the bottom-up credit work is absolutely crucial, but we always start with what's the economic backdrop? What do we think that backdrop looks like, 2 to 6 quarters out, and start there. And if you see some headwinds coming your way, you want to bring down your credit positions, no doubt.
I think for us, it's really industries. I think as a manager, you're going to make individual credit mistakes, but if you look over the last 20 years, at periods of time, people get hurt by being in the wrong industry or overweight the wrong industry. And in the new Amazon world, you've got so much disruption. The obvious ones being retail, brick and mortar, and supermarkets, and now they're getting into healthcare. And so I think what we're spending a lot of time on as we look at quarterly earnings and spend time with management teams is really, what is fundamentally changing in this industry? And these companies are highly levered, so a lot of them can't pivot their business model as fast as Amazon is disrupting their business model. And so ours is really just a real focus on the underlying earnings trends industry by industry.
Yeah, a couple of things that we look at. One would be looking at an index and if there's an industry that starts to overtake that index. A good example would be like 36% of telecom back in the early 2000s. There's some of that's something to keep an eye on, and it gives you an idea of where there's too much leverage in one industry. I always look at defaults. Everyone comes to me and says, hey, defaults are really low, you should be buying high yield. That's the time I want to sell. Usually when things are too tight, from a risk standpoint, that's when I want to sell. You know, so it's to me, it's kind of like, you know, when the ducks are quacking, you feed them, and they're quacking, so let's feed them. So those
I
are
don't
the
know
kind
that
of
saying,
things
but
I
I
look
like
at.
it. That's good.
But those are the things I look at.
You know, it's always hard to figure out what's going to cause the next sell-off, but bubbles are almost always created by excesses that get built up in the marketplace. And so when you try to think about what's the canary in the coal mine, what's going to create it, it's about looking for what excesses get built up into a marketplace. So one of the things at Shankman that we really focus on is risk-taking at new issue. Because what it tells you is when investors become risk-loving, they're willing to buy a lot riskier names that eventually get into the market, build up, and then you wind up having it have to deflate. So one of the ways that we measure that is the percentage of LBOs and acquisition financing that occur as a percentage of new issues. And I think that when you look at that, what you see is it's around 20% of the market. 60% of the market remains refinancing activity. If you go back to 2007, almost 50% of new issuance was LBO and acquisition financing. So a dramatically different type of company is coming to marketplace. But I think if you watch that trend and if you see it increase dramatically, it tells you that maybe we're 12 or 18 months away from really having some bigger issues in the marketplace. And so it's something that we spend a lot of time looking at.
That's great.
It's kind of hard to pick one thing. All of the comments that I've heard are areas that we think about. But I guess if I had to sum it up in one word, leverage. We always look to where the leverage is to tell us where the next crisis is. If you go back pre-crisis, the leverage was in consumer credit. People using their houses as ATM machines, the extreme amount of leverage, the overspending that was going on. Fast forward to where we are right now, and the over-leverage is in corporate America. And all of the things we've talked about, whether it's the relative relationship between triple Bs and non-investment grade, whether it's the over-levered balance sheets, overrated companies, this is where we feel that the risk is. And for right now, you're not getting paid to take that real leverage risk because, you know, while it may not be the trigger that causes the next slide or the market risk-off moment, it will be the place that probably experiences the most pain. And so, you know, so like CLO squared, which is just basically a leverage play pre-crisis, here we are today and avoiding the areas which are over-levered and over-risked, if you will, to all the elements that all my co-panelists have talked about.
Awesome. Thank you. Okay, anybody in the audience? Yeah. Is the mic coming to you?
This is a super serious question, maybe for Mr. Slatke. What's the most annoying thing an analyst ever told you?
I love that.
That it wasn't their decision to buy.
I have one. An analyst said, I said maybe buy. So I said, okay.
One?
Oh, that only happened one time, right?
I thought it was for him. Yeah. Just when I asked an analyst back in a long time ago about a sector and if we could look at something different, maybe a little bit different market, came back and the relative value was where I told him to look, and he said, I never looked at it. I didn't have time. It's not an excuse, but that's probably the most difficult conversation I had with an analyst.
Ann, you got anything?
Oh, I have too many. Probably when a company is going bankrupt and you have the opportunity to buy the equity, don't. That was my advice to this person when they had purchased the equity.
Yeah, go ahead.
Question. Everyone on the panel's talked about this a little bit, but Ann in particular. December 18.
Same thing.
So, December 18, I call them tourists or Johnny-come-latelys, the investors in ETFs or mutual funds or foreign institutional buyers who are new to the space of loans and high yield. They haven't been through problems before. So in December of 18, that V-shaped trading that we saw in the recovery next year. How much assets in ETFs and mutual funds and high yield funds left the market? How much redemptions actually happened? Have we been tested yet in these daily liquid vehicles with everyone heading for the exits at the same time? Was December of 18 a test, or was that just a blip?
I don't know about December, but I know 18 for high yield was difficult as far as flows. And the first quarter of 2019 has been very strong. I think the number, I'm going to throw a number out, but 40 billion of outflows in 2019.
What, for those of us who don't know the total AUM, what kind of percentage is that?
Well, it's a huge market. It's a $1.3 trillion market. So I don't know what's.
In the daily liquid vehicles.
Well, I mean, in the,
Where's the terminal?
in the loan,
Let me-
in the loan mutual
someone got a
fund
Bloomberg.
space, it was 18%. You know, just over that withdrawal period. So I mean, a pretty substantial number.
But I think if you look at trading volume, you could look at Trace trading volume in December. It was, I feel pretty comfortable saying it wasn't a real test. It's just the market, you know, tends to be very liquid in December, and you compounded that with abnormally high outflows, but it wasn't something that I would say was the real test for the market.
I think it was a pretty big test. So when you have 20% of retail outflows, that's a pretty big number for the part of the market everybody's worried about. And I think your question is a really critical one when you think about liquidity, because liquidity to us is defined two ways. One is, can you sell? And two is, at what price? And you may not like the price, but you can sell. And if you look at the bank debt market was down 4.5 points across the entire asset class, which is a lot for that marketplace to be down. However, we didn't really hear about any mutual funds or ETFs not being able to service outflows. So I do think it was a test for that part of the market that it's going to cost you, but you actually can get the liquidity if you need it.
A great place to end it. I'm so sorry. I think we're out of time. Thank you, everyone. This has been awesome. Thank you to our panelists. Thank you. This is awesome.